Thank you for joining us at xm.com for today's market comment by Marios Hadjikyriacos. I'm Maria Bashir-Davies. The shockwaves from the seismic rally in U.S. bond yields have started to cause tremors in the stock market. Shares on Wall Street fell sharply last week as a mixture of geopolitical concerns and a meteoric rise in U.S. yields dampened risk appetite, sending investors scrambling to reduce their exposure to riskier assets. With the U.S. government boosting its debt issuance to fund enormous budget deficits, and a streak of encouraging data releases that have seen Fed officials preach a higher-for-longer regime on rates, the demand-supply dynamics in bond markets have shifted in favor of higher yields. The yield on 10-year notes hit 5% last week for the first time since 2007. Overall, the risks surrounding stock markets seem tilted to the downside. The S&P 500 is still trading for 18 times forward earnings under the analyst assumption that earnings will grow 12% next year. Hence, valuation multiples have not truly compressed despite the ferocious spike in yields, while the projected earnings growth seems over-optimistic heading into a global slowdown. Geopolitical worries have been front and center this month. The hostilities in the Middle East came out of the blue to rattle investors, generating an influx of demand for safe havens such as gold and commodities like crude oil that could see their supply flows disrupted if tensions in the region escalate. What's striking is that although gold prices have acted as the barometer for geopolitical tensions lately, other classic safe haven instruments, such as bonds and the Japanese yen, have been almost immune, barely responding to the conflict. In other words, geopolitical stress in the markets has been contained to a handful of instruments. As for gold, it currently appears vulnerable to a downside correction. Bullion has risen around 9% in 2 trading weeks, as safe haven demand overpowered the selling pressure exerted by soaring real yields. A sense of calm has descended upon the FX market on Monday, with most currency pairs trading in relatively narrow ranges and without any clear direction. Euro-dollar will be in the eye of the hurricane with the latest round of business surveys tomorrow, ahead of the European Central Bank decision and the quarterly U.S. GDP report on Thursday. Finally, the yen continues to trade near the 150 mark against the dollar, unable to capitalize on media reports that the Bank of Japan might consider some further policy tweaks at its meeting next week. Thanks for watching today's market comment here at xm.com.